Hi, this is Dr.S.Valluvan, Associate Professor, MBA. Now, in this video, I'm going to teach about the primary market. What is primary market and how it works, and also about the initial public offerings. Let's move into the topic. This presentation will be consisting the following components: introduction to primary market, initial public offering, how to apply for public issues and rights and responsibilities of shareholders, information in offer document, price discovery of shares, and etc. Now coming to a primary market, new issue markets where company institutions raise funds or capital from public by issuing new securities. These securities are freshly issued to the public for the first time. That's why it's called as new issue market. It is otherwise called as primary market. The objectives of the primary market is to raise capital for the business. Of course, the capital can be raised in through ways, through debt and through equity. As far as the IPO is concerned, fund is raised through equity, that is raised through the public. There are two major types of issuers of securities: corporate entities, that is companies, and government, that is central and state governments. So major types of issues in primary markets are public issues, preferential issues, rights issue, bonus issue. Why the companies issuing shares, why they are going for public? The objectives are, if a company wanted to start a new projects or they want to expand their business, existing business they want to expand, and the diversification and upgradation, new technologies or new plant and machineries and all. These objectives of raising funds will be mentioned in the offer document. This slides depicts the financial markets. It is classified into two: money market and capital market. The capital market furtherly divided into two: securities market and other forms of lending and borrowing. Security markets furtherly classified into two: new issue market, that is primary market, and secondary market. This slide shows the difference between the primary and secondary market. Based on the definition context, the primary market is securities issued first time to the public, and secondary market is a trading of already issued and listed securities, which will be gets traded in the secondary market, that is stock market. Primary market also called as new issue market, whereas secondary market is called as post issue market. Based on the price discriminations, primary market by issuer company in consultations with merchant bankers, they will determine the price. In secondary market, price determinations is based on the supply and demand forces of the market. Key intermediaries in the primary market: merchant bankers, lead managers, etc. In secondary market, stockbrokers and DPs, depository participants. Purpose of primary market: raising capital for expansion, diversification, etc. to seek listing of securities. The purpose of secondary market is trading of securities. Whoever wants to buy the securities shares in the secondary market, they can buy and sell the shares, and providing liquidity to the investors. Any number of shares can be bought and sold, and raising further capital for expansion. These are the purpose of secondary market. Mode of public issues. There are different modes through which the issues can be done: public issues, right issues, bonus issues, and private placement. As far as the public issue is concerned, it is further divided into two: IPO and FPO. In IPO, fresh issues and offer for sales. Two types of issues are there. In FPO, that is follow on public offering, fresh issues and offer for sale. As far as the private placement is concerned, preferential issues is there and qualified institutional placement is there. We'll see one by one as we go along. Mode of capital issuance. In IPO, initial public offering, it is done by the unlisted company. Fresh issue of securities will take place. Offers its existing securities for sale and combination of both. Securities issued for the first time to the public, it paves the way for listing and trading of the issuer's securities in the stock exchanges. In FPO, that is follow on public offering, it is otherwise called as further public offer or follow on offer. It is done by already listed companies. If they want a further fund or further capital, additional capital for the business, then the already listed companies will issue shares in the market for additional capital. A fresh issue of securities offer for sale are the example for FPO. And coming to a rights issues, it is done by already listed company also. Issue of securities to its existing shareholders. So rights issue will be taken place. The company will issue the shares to the existing shareholders. The shares to the existing shareholders. And bonus issue, it is done by already listed company. Issue of shares to existing shareholders. Existing shareholders need not make any payment for bonus shares. Shares are issued out of the company's free reserve and share premium account. Issued in a particular ratio to the number of securities held on the record date. Preferential issues done by already listed companies. Issue of shares, convertible securities to select a group of persons, subject to prescribed norms such as minimum pricing, minimum public shareholding and a lock-in period. Qualified institutional placement. It is done already by listed company. Issue of shares, convertible securities to qualified institutional buyers, that is bank, insurance company and mutual fund companies. These are all the companies will participate in this kind of mode of capital issues. This slides depicts the initial public offering, some of the features. Process of a company to be publicly listed and a traded company. IPO is a fresh issue of shares, offer for sale of shares by existing investors, combination of both. Process of IPO is as follows. This diagram shows the process of IPO. Issuer files an offer document. That is, issuer means a company. Those who want to coming for a public offer, they will file a document in a prescribed format with Securities and Exchange Board of India, stock exchanges and the Register of Companies ROC for listing on the stock exchanges. Now the company will receive the observations from the regulatory authorities like SEBI. After complying with all the observations, issuers can open offer inviting general public to invest in an IPO subject to stipulated timeline. The issuer will approach the investment bankers. The investment banker is the expert. They do initial public offering for the issuers. Post successful completion of the offer, the shares of the company are traded on stock exchange, that is in the secondary market where the shares are listed. How to apply in public issues? This is a practical process where you want to apply for a share in a primary market. ASBA, this is an online mode, application supported by a blocked amount and facility provided by self-certified syndicate banks. So full bid amount blocked in the bank account of the bidder. So this will take plays in the online mode. Then UPI in ASBA, retail individual investors, shareholders bidding in the shareholders reservations portion up to 2 lakhs. Application via UPI facility of sponsor bank. There will be banks that are tied up with the investment bankers. Those who want to apply the shares in IPO, they will do these facilities through UPI and 3-in-1 account. Applying in IPO through 3-in-1 account like Demat, trading and bank account. So through this Demat account, you want to apply for IPO. If you want to apply for IPO in offline mode, this can be done through filled form. To open a Demat account first, investors may obtain application form from stockbroker or sponsor broker or exchange website. Form submitted to stockbrokers or sponsor bank, through which you can apply for IPO. This slide depicts the rights of shareholders. He is a part owner of the company in proportion to their holding in the company. Right, they have the right to receive corporate benefits like dividend whenever declared. Right to receive the annual report through their email, audited financial statements, notices of general meeting and other notices, other information disseminated by company. The right to attend the meeting, AGM, and they have the right to contribute in key corporate governance decisions through postal or ballot e-voting concept. They have the right to ask questions to the board of directors. They have the right to place items on the agenda of general meeting. They have the right to propose resolutions and to vote in company proceedings, to approve merger and acquisitions, appointment of directors of company board, changing auditors, etc. These are the rights the shareholders having. Then right to inspect of company's statutory books and records, to transfer shares by applicable laws, to raise grievances, if any, against the company. So these are the rights a shareholders will have when they become a shareholder of a particular company. So these are the responsibilities of shareholders. Annual report circulated to all the shareholders, available on website of company and stock exchange. For shareholders meetings with details of the agenda, the managing director's notes, and the annual report to understand how the business is doing. Auditor's note, check if there are any red flags, adverse findings flagged. So they have to carefully gone through these kind of informations. Thank you.